A new business owner earns $95,000 in her first year. She pays herself irregularly, keeps no separate records, and doesn't make estimated tax payments because she didn't realize she needed to. In April, her accountant presents a bill, $21,400 in federal income tax, $13,400 in self-employment tax, $2,800 in underpayment penalty and interest. She owes $37,600 she doesn't have. She puts it on a credit card at 24% APR. She could have avoided nearly all of the penalty with 1 hour of setup in month 1. The tax setup nobody does on day 1 is the most expensive mistake in a first-year business. Startup costs under IRC Section 195 have a specific deduction structure that most new business owners miss. You can deduct up to $5,000 in startup costs in your first year of business, but only if your total startup costs are under $50,000. Above $50,000, the $5,000 deduction phases out dollar for dollar. Any startup costs not deducted in year 1 must be amortized over 180 months, 15 years. This applies to costs incurred before your business opened, market research, professional fees, incorporation costs, equipment deposits. Document every pre-launch expense with date and purpose. They are almost certainly deductible. The quarterly estimated tax payment system is non-negotiable for self-employed people. If you expect to owe $1,000 or more in federal tax after withholding, you are required to make quarterly estimated payments April 15, June 15, September 15, and January 15 of the following year. Missing or underpaying these results in a penalty under IRC Section 6654. The safe harbor amount is either 100% of last year's tax liability, 110% if your AGI exceeded $150,000, or 90% of your current year liability. In your first year, you have no prior year liability, so you must estimate current year income and pay 90% of that amount across the 4 quarters. The S-Corp election is one of the most time-sensitive tax decisions a new business owner faces. An LLC elects S-Corp taxation by filing Form 2553 with the IRS. The deadline to elect S-Corp status for the current tax year is March 15 for most calendar year businesses, or within 75 days of the entity's formation if you're filing near year-end. Miss this deadline and you're locked into your current tax treatment for the full year. For a business netting more than $50,000, the S-Corp structure can save $3,000 to $15,000 annually in self-employment taxes. This election requires a 4-minute form. The cost of missing it is a full year of additional SE tax. Bookkeeping software is not optional. It is your legal protection, your deduction engine, and your tax preparation foundation. QuickBooks. Self-employed starts at $15 per month and connects to your business bank account to automatically categorize transactions. Wave is free. FreshBooks starts at $17 per month and integrates invoicing with expense tracking. The software doesn't matter as much as the discipline. Every transaction categorized weekly, every receipt photographed and attached, every income deposit matched to an invoice. Year-end tax preparation without this system costs $300 to $800 extra in CPI time, in addition to the deductions you'll miss. The home office deduction is available in 2 forms. The simplified method allows $5 per square foot of dedicated business space, up to 300 square feet, a maximum of $1,500. The regular method calculates the percentage of your home used exclusively and regularly for business, and applies that percentage to actual home expenses, rent or mortgage interest, utilities, insurance, and depreciation. For most self-employed people working primarily from home, the regular method produces a significantly larger deduction, but requires more documentation. The key word is exclusively. A spare room used as both an office and a guest room does not qualify. Set up a percentage-based tax reserve system on day one. When each client payment arrives, immediately transfer 30% to a dedicated tax savings account. Adjust the percentage based on your actual marginal rate. For higher earners, 35 to 40% is safer. This account is never touched for anything other than quarterly estimated tax payments and the annual tax balance. The psychological and practical effect of never seeing the tax money in your operating account is significant. It prevents the end-of-quarter scramble for funds and makes quarterly payments feel like routine transfers rather than financial emergencies. Retirement contributions in your first year are both a tax planning tool and a financial foundation. A SEPI contribution made before your tax filing deadline reduces your net self-employment income, and therefore your self-employment tax, as well as your income tax. A $15,000 SEPI contribution in a strong first year could reduce your tax bill by $6,000 to $8,000 depending on your bracket. This is money you are going to pay in taxes that you instead keep, tax-deferred, in a retirement account. The earlier in the year you make this decision, the more you can set aside through systematic monthly contributions. Hire a CPI in your first year, not your second. The most expensive version of DIY tax preparation is the one where you file incorrectly, miss elections and miss deductions, then pay a CPI in year 2 to clean up the return and amend year 1. A CPI familiar with self-employed clients costs $400 to $1,200 for an annual return, depending on complexity. The deduction discovery alone, home office, vehicle, retirement, health insurance typically covers the fee 2 to 4 times over. More importantly, year 1 sets the baseline. If year 1 is wrong, every subsequent return is built on a flawed foundation. The legal setup from Part 1 protects your personal assets. The tax setup in this video determines how much of your earnings you actually keep. Quarterly estimated payments, startup cost deductions, the S-Corp election deadline, a bookkeeping system, and a first-year CPI. These are not advanced strategies. They are the minimum viable tax infrastructure for a real business. If you haven't registered your business entity yet and want to start from the legal foundation, Part 1 of this series covers everything you need to do before your first invoice. One of the deductions mentioned here is worth its own deep dive. Startup cost deductions breaks down the $5,000 first-year write-off most new businesses miss, the $50,000 phase-out, and the separate limit nobody claims. It is on this channel.